This meeting is being recorded.
Good evening, friends. At the outset, I welcome all of you on behalf of WIRC. So, this initiative is by the Capital Protection and Investor Protection Committee, and I am very thankful to CA Sunil Singhania ji for accepting our request and guiding us on this vital topic. Friends, we are seeing that the entire economy, the global world, is going through tandem. So now we rely on the Indian economy, and today is the phase where we have seen the markets from 17,000 to 15,200, and then again to 16,700. So a question arises in the mind: what is the way ahead? Does the Indian economy and equity markets have the potential? So we have the best, one of the best speaker, CA Sunil Singhania ji, and we are very eager to hear him. So thank you very much, sir, for accepting our request, and we are very obliged to you. Thank you, sir. Now I will request C. Aditya Maheshwari to please give the formal introduction of Sunil, sir.
So, sir, I think ICI motto would come.
Okay.
I think request everyone to keep their hand on the
Yaesha supteshu jagrati Yaesha supteshu jagrati Kamam 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 Purusho nirmimanaha Tadeva shukram Tada Brahma Tadeva Amritamucchate Tasmin lokaha Shataha Sarve tadunatyati kaschan Etadvaita
Thanks, Ankit. Good afternoon, members. It's a great pleasure for me to introduce our today's speaker, CA Sunil Singhania, who is going to share his views on Indian economy and equity markets potential ahead. Sunil Singhania is a BCom CA with All India rank and the right to use Chartered Financial Analyst designation conferred to him by the CFA Institute. He is the founder of Abacus Asset Management LLP, an Indian-focused asset management company which is established in 2018. And under 4 years, Abacus is already managing assets on almost 10,000 crore. Prior to Abacus, he was as the global head of equities at Reliance Capital Limited. He oversaw equity assets and provided strategic inputs. And as CIO equities, Singhania led Reliance Mutual Fund equity schemes to be rated among the best in the country, and notably, Reliance Growth Fund grew 100 times in less than 22 years under his leadership. Also, he managed around 80,000 crore assets invested in Indian equities during his tenure. He was rated the best fund manager by Outlook Business in 2016 and 17 over a 10-year period time frame. He is also the first individual from India to be elected as a member of the CFA Institute Board of Governors and served as a governor for 6 years, and also a founder of CFA Society India and served as a president for 8 years. Currently, he is the only Indian to be appointed on the IFRS Market Advisory Committee 2022-23. He has having traveled extensively across the world. Singhania has attended many global investment conferences and seminars and is active in social and society work, having served as the president of Goregaon Sports Club, Mumbai. Sunil is widely covered in media, including having featured in the famous show Wizards of Dalal Street on CNBC, and as an ongoing show Market and More with Sunil Singhania on ET Now. With this brief introduction, we welcome you, sir. We hand over the proceedings to you. Thank you.
Thank you, Aditya, for a wonderful introduction. And thanks everyone for joining in. Though I'm seeing only 44 participants, and I don't know whether it's a good number or not, but at least I am a little disappointed. Anyway, I think, Ankit mentioned about the markets going up and down. First of all, I think, at least as far as our philosophy is concerned, we believe that markets are for investing and not to look at it from a month on month or a quarter on quarter or a week on week basis. And, last 25 years, the country has seen so many events which keep on coming and which we have seen lead to markets correcting significantly. But I think wealth has been only made for investors who have had the confidence in the economy from a longer term perspective. And all the well-known investors, whether globally or in India, have been investors, who have taken the call of staying through thick and thin in terms of the near-term challenges which keep on coming up. So I think with that, I would, have a small presentation. Can I just...
सर शेयर स्क्रीन नहीं है सर, सामने शेयर स्क्रीन है, उसमें शेयर करिए सर.
Yeah, it's not allowing me to. Okay, yeah. Are you able to see the presentation?
Sir.
Okay. So it's a very detailed presentation, but what I will try to do is first give you a small perspective on the longer term opportunity and then also touch upon some near term concerns, because obviously in the near term also investors and prospective investors tend to get a little bit worried about what is happening. So we'll try and cover both the longer term and the near term. So first, from a longer term perspective, I think what we have tried to do is take a 30-year view of how India has grown over the last 30 years, and then try and see what is going to happen in the next 3-4 years. So across the board, we have seen India become very, very strong. From a nominal GDP of $300 billion, we are now almost $3 trillion. We are almost, fifth or sixth largest in the world. In terms of purchasing power parity, we have grown 8x from 1 trillion to 9 trillion. In terms of purchasing power parity, GDP, we are the third largest in the world after US and China. In terms of the world GDP, our share has increased from 1.2% to 3.1%. And our per capita GDP has also moved up from $300 to as much as $2,000. And again, on a PPP or purchasing power parity, our GDP per person is now exceeding $7,000. We used to be always having this concern about forex reserves, and for those who have been tracking Indian economy, and for those who are as old as I am, we would all remember that we also had a scenario where our gold had to be pledged because India ran out of forex reserves in 91, and from that level of $5-6 billion, we have come to having $600 billion of forex reserves. Again, the top 3-4 in the world to have this kind of reserves. And as we move forward, and if we take just the IMF estimates, again, India comes out as one of the fastest growing economies. In fact, this year also, despite what is happening globally, India would grow almost 7 to 7.5%, which would be twice that of China and the highest in the world. And I think this is something which is very important, because when you are investing in equity markets, you have to invest in the equity markets of the economy where growth is very, very strong, and India presents that opportunity. What we have tried to do now is divide India. We all know India is a large country, and what we have tried to do is just present to you that India is a combination of so many countries. So Maharashtra is the size of Mexico, and Karnataka is the size of Italy, and Rajasthan is the size of United Kingdom, and Madhya Pradesh is the size of France. So, if you see some of the very, very large countries are like states as far as India is concerned. And that again shows the potential as far as India is concerned. I mentioned to you that India is the 5th largest, and I also mentioned to you that it is one of the fastest growing in terms of per capita income, which can be seen on the right-hand side charts. In terms of the current scenario, we are much better positioned. So obviously our current account deficit used to be significantly at a deficit level. In fact, last 2 years we had a current account surplus, and this year, despite oil prices being so high, our current account deficit is a respectable only -1%. Forex reserves, I mentioned to you, $600 billion, and that gives us the confidence that the kind of shocks which Indian currency used to have earlier will not be there. We are all talking about Indian currency hitting 80, but if you actually see British pound from 101, 102, in fact 105 has become now 94, 95. The euro from 88 has become 82, and Japanese yen has also depreciated vis-a-vis the Indian rupee by almost 10 to 15%. It's the dollar which is strengthening, and I think to that extent, Indian rupee has been one of the better performing currencies. One interesting thing is that we all know how dependent India is on import of oil, but one heartening thing is now our IT exports are almost equal, and in fact they've surpassed our oil import bill. So whatever we lose in terms of foreign exchange, in terms of oil imports, is more than made up by way of IT exports, and that clearly presents the strength of India in global services industry. Fastest growing economy, I mentioned to you, 5th largest in terms of market cap. These are some of the transformational trends. We had 3 transformational trends. You're all chartered accountants. One, we had the GST, which obviously has led to more compliance, and the tax to GDP ratio is also increasing. We had the Jan Dhan, where it was bank account for all, and now you have the Aadhaar also, which is linking every single thing. So again, having the background of chartered accountancy, you would all know that evasion used to be big in India, and with this linking of PAN and Aadhaar and mobile to every transactions which we do, I think this country is becoming more and more efficient. As a percentage of household assets, equity is still small, and despite the fact, if you see 21/20, despite the fact that during the pandemic, the COVID pandemic, more and more investors took to equity markets, Indian household exposure to equity is still 5%, and there is a long way to go and big room as far as this percentage to go up is concerned. Digital transformation, India comes out as the cheapest as far as the price per GB of data is concerned. And this is something which is going to completely transform the efficiency as far as India is concerned. We all know that India has come out as a country where there's a lot of corruption, and this digitization is leading to a reduction in consumption. There was a time when we used to pay money to get telephone connections, and now it is available on the spot. We can do everything online. Passports used to take months. Now within 2-3 days you can get your passports done. Death certificate, birth certificate, property records, multiple stamp duty payments, and so many other things which used to take days and weeks and months are all possible because of this huge move toward digitization. Dissemination of information is phenomenal. Even the farmer in the remotest of remote place in India now knows what the price of his produce is because of data being available everywhere and internet connection being available everywhere. Because of this cheap data, India comes out as one of the fastest growing broadband markets in the world. And data usage has also been jumping. It's grown 17x in the last 5 years, and these are dated numbers. I think I'm very sure that these numbers would have gone up even more. And this is going to really transform. If you remember, even in the equity markets, there used to be open outcry system till NSE started operations in '94, and now you can see how efficient the equity markets have been. Same is the case with share certificates. Earlier, you used to have physical share certificate, which used to take two months to get transfer in your name. Now it's completely demat. You don't have to show the certificates. It is safe. It is fast. It is so efficient. And I think this digital transformation is going to change many other things. And I'm very sure even in your profession, you are privy and you are getting exposed to what I'm saying. There is this concept called China plus one. I think what it clearly means is that China was the manufacturing hub of the world. Um, and over the last 2-3 years, China has sort of become a threat to the world. And to some extent, at least to the Western world, China is also coming out as something which is not exactly a friendly country. And this is making them move away from China to whatever extent possible. Obviously, China is so large in on the manufacturing side that you just cannot ignore it. But to the extent possible, I think companies and countries in the Western world are looking at alternatives. And though there are other alternatives like Vietnam and Thailand and Malaysia and Turkey and so on and so forth, I think even in India, we are seeing that advantage of this China plus one strategy coming up. Along with it, the fact that even the Indian government has been encouraging Make in India through various announcements and policies like Make in India tax benefit. So if you set up a new manufacturing unit, you all know that the taxation is only 15%. You have the PLI scheme, which is the production linked incentive scheme across some 12 sectors, which is boosting the propensity and the eagerness of corporates to set up manufacturing base in India. And obviously, India has this huge talent pool and cheap labor cost, which is also benefiting manufacturing in India. So I think this China plus one strategy is clearly visible in textiles, in engineering, even in metals, chemicals, pharma. We are seeing this export rise very visible. Exports are growing at upwards of 20-25%. And to some extent, this PLI scheme, as and when it starts, will be a big boost. Along with it, imports are reducing. India is the biggest consumer of mobile phones in the world, and 100% of the mobiles were imported. Now, almost 30-35% of the mobiles have started getting manufactured in India. And with PLI scheme, as I said earlier, getting implemented, this ratio, for example, of mobiles, electronics, refrigerators, TVs will only increase. Other proactive steps we mentioned about Make in India, PLI. I mentioned to you about corporate tax rate, that a new manufacturing unit has to pay only 15% tax rates. There have been various reforms. Divestment is a reality. And very clearly the focus of even the last union budget was completely on planned expenditure, which is capex, and we are seeing that in terms of roads being constructed. For the last 70 years we had 75 airports, and now in the next 7 years we will add another 75. And even the trains have been reformed. We have really good train services which are coming up. So I think the government is also pushing a lot in terms of development. Wages we mentioned to you. PLI I again mentioned to you. This is self-explanatory. I can share the presentation later and it can be circulated, no problem. And even in tax rates, India now stands out as one of the most competitive in the world. From a talent pool, there is absolutely no doubt that Indians are endowed with great engineering and mathematical talent. The who's who of the foreign or the global companies are now led by Indians, including the Google, Microsoft, Twitter, IBM, and so on and so forth. VC funding in India has been very strong. So if you see now, VC funding, which was $13 billion in 2020, has already crossed $35 billion in 21. And as we move forward, the potential of VC funding increasing in India continues to be phenomenal. The startup culture is buzzing. If you happen to be in startup hubs like Gurgaon or Bangalore or even Hyderabad and pockets of Bombay, you can see the young professionals now looking at startups with a lot of enthusiasm. Now we come to the market outlook. So in short, I think the idea of giving you a perspective of the Indian economy was that, if the economy is strong, markets will be strong. Ultimately, there is a dialogue that, films are all about entertainment, 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 and markets are all about earnings and earnings and earnings. And earnings are all about how the economy is going to be, because if the economy doesn't grow, the companies will not grow. And if the companies don't grow, the earnings will not grow. And if the earnings don't grow, the markets will not grow. So in short, I think the economy is looking pretty good. Another way of putting it at the economy in a very simplistic way is that we got our independence as a country in 1947. It took us almost 60 years. So, 2007 is when India as an economy reached $1 trillion in size. So 60 years to reach $1 trillion. The next 1 trillion took only 7-8 years. So what we achieved in the first 60 years, we were able to achieve in the next 8 years. And as we speak, after almost 75 years of independence, we are celebrating the 75th year of independence this year. We are $1 trillion in economy. And at least I am very positive that this 3 trillion is going to become 6 trillion in the next 6-7 years. So the wealth which we have created as Indians over the last 75 years is going to be created over the next 7 years. And I think that is the opportunity. So for the young professionals who believe that, अरे रह गए, पीछे रह गए, पहले वाले ने बहुत wealth create कर लिया, बहुत opportunity आ गई, we can only say that what has been created over the last 75 years is going to be created now in the next 7 years. And I think that is what every one of us should look at. Coming to the market outlook, very near term, these are the things which are impacting the market. I will touch upon each one of them separately. So one is the geopolitical news flows. We all know that Russia attacked Ukraine in February. And after that, there has been a lot of issues. Inflation went up because all the commodity prices went up. Oil, metals, oil seeds, food, wheat, everything went up. And there was a lot of negative news flow. Obviously, the markets reacted to the extent that Nasdaq went down by 30%, and even Indian markets went down as much as 20%, and mid and small caps went down by almost 30%. However, as we speak, I think our view is that the peak of the conflict has already been behind us. The conflict is still going on, but rather than it being completely, in the whole of Ukraine, it's now concentrated in the southern and the eastern part of Ukraine. In fact, if you would have tracked the embassies of US, India, and so many countries which had shut in Kiev, which is the capital of Ukraine, have all started or recommenced 3-4 weeks back. And to that extent, our view is that incremental news flow should not be there. Obviously, we need to monitor the situation because in a war, egos are more important than any rational decisions. And I think that is something which we have to watch. But our view is that the worst of the news flow is behind us. The second was high oil prices. Oil prices which had fallen to like $20-$30 during COVID went up to $70-$75. Obviously, when normalcy returned. However, when Russia attacked Ukraine, and Russia is a big producer and exporter of crude and gas, oil prices shot up to $135. They have now come back to anywhere between $95 to $100. Our view over the last 2-3 months has been that oil is headed to $75. And this is despite the fact that global companies and global funds like, Goldman have given projections of $150 and even $380 as far as oil is concerned. And our logic of lower oil prices is very simple. We are not experts in commodities. We are not experts in global oil prices, but we do track basic indicators. So our view is based on the following. One is we do believe that OPEC countries like Saudi and, Abu Dhabi in particular, and some other smaller countries have the potential to pump in at least 2-3 million barrels more. I think they've already started doing it. Second is countries like Iran, Venezuela, and all on whom sanctions were imposed by US. They have a potential of producing, in the worst case, another 2-3 million barrels more. And shale oil, which is predominantly produced in US, the production had fallen from 11.5 million barrels to 6.5 million barrels, because in US oil is produced by private companies, and they would not produce oil if their cost of production is higher than the price at which they can sell. And therefore, when oil fell to $40 and $50, the production of oil in the US reduced. Now with oil back to 70, 80, and $100, I think production looks like increasing. There is a concept called rig counts. So rigs are needed to produce oil. So the number of rigs which are deployed in US have shot up by almost 65% over the last 1 year. And that gives us the confidence that in the next month and 2 months, we will have US starting to produce back to where it was producing earlier. So on one hand, you will have a supply of oil which is increasing. And on the other hand, because of this huge jump in oil prices, so in US, for example, a gallon is 4.5 liters of petrol, which used to cost $2.5, is now costing $5 to $6. And if you have a family of two with 2 cars, your monthly expense only on petrol has gone up by $1,000, and that is leading to reduction in demand to the extent of 3-4%. So on one hand, you have supply which is going up, and on the other hand, you will have demand which will reduce, and as a result of which fundamentally oil looks very, very weak. And then you have countries now getting threatened because of fuel security or energy security, and European countries have already declared that nuclear energy would be treated as renewable energy. They are looking at restarting their nuclear plants, which are shut after the accident in Japan a few years ago when there was a tsunami. Hydrogen and other alternative sources are also getting more and more prevalent, and therefore our view fundamentally is that oil is heading towards a weak kind of a trajectory in the medium and long term. In the near term, obviously, small announcements and small events do cause oil to sporadically move up $5-10, and we should be prepared with that. On the inflation front, which has been a cause of worry, inflation has shot up in US to 30-40-year high. Even in India, it shot up to double digits. And as a result of which interest rates were also increased across the world. Even on the inflation front, we believe that commodity prices have peaked. If you track steel, aluminum, copper, zinc, across the board, there has been 20-40% fall in commodity prices. Cotton has fallen by 35-40%. Oil, as I mentioned, from the high is already down 25%. And even other commodities, whether it is petrochemicals or whether it is rubber or a lot of other commodities, have all fallen very sharply. And markets also behave according to reality versus perception. So the perception now is that inflation is very sticky and interest rates are going to be very high. Our view is that markets have over discounted, and on both the fronts, there is a possibility that inflation might not be as sticky as the markets are expecting, and interest rates might not rise to the same extent which the markets are expecting. In fact, the 10-year yields in the US, which had shot up to 3.4%, are already down to 2.8%, which is clearly indicating that the markets have started to factor in that interest rates might not go up to the same extent as the markets are expecting. FIs have been record selling last 6 months. Again, our view was that we are coming to an end, and it has been proven right. Last 4 days, FIs have been net buyers. Today, let's see, the numbers are still not out, but our view is incrementally FIs have to come to invest. And actually, if you see, what typically happens is that when dollar strengthens and when interest rates are high in the US, all the money moves into the US. And now with that stopping, dollar is also incrementally stopped strengthening. And as I mentioned earlier, interest rates don't look like moving up. In fact, at the margin, they can only look down. FIs have started to look at investing outside of US. And then when you look at their options, Europe is the most impacted because of what is happening in Russia. I think as a region, the worst hit is going to be Europe in terms of the growth rates. They are definitely going to have negative growth rates. China, I mentioned to you earlier, is the villain of the world, and Russia, no one is going to invest. So I think India stands out as one of the few countries where money flow can be really, really good. And I think that we believe is going to happen. It's already started, but it can happen in more vigor. And again, I mentioned to you earlier, INR depreciation is going to strong dollar. In fact, among all the other major currencies, rupee clearly stands out. So net, I think the demand environment has been very strong. If you go to the rural areas, last 3 years have been phenomenal monsoon. Agricultural produce has been good, and agricultural prices, whether it is soya, wheat, rice, sugarcane, cotton, has been all pretty good. And this year, there was a little bit of scare when monsoons were delayed, but now, the whole of India is seeing more than average monsoon. So rural economy is doing well. Urban economy, the salary levels are moving up. We're already seeing in IT shortage of people. Salaries are up 25, 30%, and across the board, despite inflation, I think people are not, crying in a sense because income levels are pretty decent. Also, we have to remember that this is the first festive season in 3 years, which will be celebrated with normalcy. So we had 20 and 21 festive season getting impacted because of COVID situation. And we all know we like to celebrate our weddings, we like to celebrate our birthdays, and we like to celebrate all the festivals. And therefore, in the next 4-5 months, festive season will start from August, when you will have Ganpati, and then you will have Dasera and Navratra, and then Diwali, and so on and so forth. So our view is that economy will show its true colors in terms of strength as far as India is concerned. Fastest growing, I mentioned. Revenues have been very, very strong. Again, you must be definitely interacting with your clients, whether it is the income tax collections, which were up 50%, GST collection on a month-on-month basis. Now 1.5 lakh crores has become like the norm, where even 1 lakh crores used to be a big number. Now it's 1.5 lakh crores, which is becoming the norm. And with this correction, Indian markets are now trading almost at 10-year average, after the last couple of weeks of strength again. Near-term outlook, from the highs, we have already corrected 10%. There has been an underperformance of Indian small cap, but good thing is that exuberance is now replaced with concerns and fear, and that basically means that most of the negatives are discounted. We mentioned earlier that India is well placed, and FII flows will definitely back, which we are already seeing. Crude is corrected. Hopefully, let's see, we should all pray that it corrects more. If crude corrects, India will stand out as one of the best investment destinations anywhere in the world. Earnings continue to be very strong. We expect a 17-18% earnings growth over the next 2 years. Earnings season is ongoing. Across the board, earnings have either met expectations or have surpassed expectations. And our view is that with the current corrections, 15-18% return from equity markets, as far as India is concerned, is very much possible. These are some of the charts. Nifty, as I said, is now just below the 10-year average. ROEs are pretty high. Repo rate has inched up, but our view is that they will slow down. And even on a price to book value, now we are almost at 10-year highs. These are some of the charts just to say what we have said. One thing which we have to remember, we all become very negative about India, but India stands out as a country which has consistently, from 1 year to 10 years, been the best performing markets in the world. And these are like dollar returns. We are not mentioning it in rupee. If you see compared to Brazil and China and Indonesia, Korea, Mexico, Russia, Thailand, and even the MSCI Emerging Market Index, see the outperformance of India across. And I think this is something which cannot be ignored. Again, corporate profit to GDP ratio, which was at a high of 5% in 2008, fell to 2.2%. We are back to 4.3%. Last 2 years, profit growth has been phenomenal. And even the expectations and actual numbers, the actuals are outperforming the expectations. Again, some charts just to show that we have fully recovered from COVID. So whether it's the EV generation, the UPI payments, electricity consumption, freight, carried, I mentioned to you GST and all. Across the board, we are now completely recovered as far as the downturn from COVID is concerned. So this is a very quick and short presentation. Um, you know, obviously, it was quick. I took half an hour, as I mentioned, 35 minutes for the presentation. Just to reiterate, we have to be investors in India rather than traders. In the near term, no one knows whether the market is going to fall by 5-10% correction, but from a medium to long term perspective, the markets will always mimic the economy. So if you are positive on the Indian economy going forward, you cannot be not positive on Indian equity markets. As far as strategy is concerned, again, very clearly, be an investor. Trading has a lot of thrill, but trading also leads to a lot of losses. There have been very, very few traders who have consistently made money, but there have been very few long-term investors who have never made money. Almost all long-term investors end up creating a lot of wealth. The other thing is, which I notice, is that when someone invests in equity markets, they expect the prices to double every year. It is not going to happen. If India is going to grow at 6-7%, which means a nominal growth of 10%, I think companies' profits can grow maybe 12, 13, 14%. And that is the kind of return which an investor should expect. Obviously, if you are able to generate 2-3% outperformance, then a 15 to 17, 18% return is a great return. And you all chartered accountants, you know that in other asset classes, tax rates are anywhere between 30 to 40%. In equity, the tax rates are still 10%. So on net of tax basis, I think equity stands and towers above any other asset class. And I think that is what a small suggestion would be. So this is a short presentation. I'm more than happy to take questions, maybe for another 30 minutes. Thank you.
Thanks, Sunilji. It was definitely a very, very wonderful presentation that you had offered. Participants, you can put your question on Q&A and I'll take that up from there. So before I take some questions from the participant as a keyword, there are a few questions on my own, of my own. One, while you talked about a lot of good things about India and a lot of positives, can you highlight probably any major themes which you think will play out in the near future, and probably we should focus on that in particular and have some allocation in our portfolio?
So see, I don't know what will play out in the near term. I can give you what themes which we are positive on. So, we are all living in a digital world. We are very, very positive on the digital as a space. And, if you actually see your own habits, normal scenario we would have met personally, the way we work, the way we study, the way we order. We are now visiting more online stores than physical stores. The way we are consuming everything, including entertainment, it's on the Netflix and the Amazon and the OTTs of the world. So I think digital is a part of our life now. The only problem on the digital theme is stocks are still not cheap. And there are a lot of stocks which are fashion stocks or thematic stocks. And we are by nature a little bit conservative investors. We like to invest in companies which make profit, where there's a profit growth, and what we pay today will be more than made up by way of future profitability. So digital as a theme is great if you come across good companies where the business models are decent and where they can make decent profits going forward. I think this is a theme which no one can ignore for ever and ever and ever. The other thing is, I think financials are looking pretty good. We are focusing on only larger banks there. Again, we have seen the NPA or the bad debt cycle play out in India over the last 10, 15 years. Banks have now become more efficient. We have never seen a scenario which we have seen over the last 4-5 years where promoters or borrowers who have not repaid getting imprisoned. Earlier in India, you could borrow money and not repay, and you are fine. Gone are the days now. Now entrepreneurs lose their company. They even have the risk of getting imprisoned, and we have seen so many, well-known, businessmen being imprisoned, a failure of repaying the debt, and therefore banks have become more efficient. And if you are believing that India is going to become $6 trillion in economy, then there has to be capex, and there has to be credit growth. So that is again one theme which we believe is good. The only thing which we are doing is focusing on larger banks rather than smaller banks, because I would say account holders are more comfortable with larger banks than smaller banks. The other thing is IT services. Yes, stocks have corrected, but this is one sector where India has global competence, and India stands out as a leader globally. There are hardly any other sector except maybe a little bit of pharma and chemicals, where again we are positive. But IT services is again a sector where I think there is a lot of work which is going to happen. Demand scenario is going to continue to be very strong. It started in 2000 when you had this Y2K, and then now it moved towards now everyone is moving towards digitization, and then everyone is going to move towards cloud. And I think at every such implementation, Indian IT services companies come into play. So IT services again we continue to like. Pharma and chemical, again, India has expertise in terms of good talent. So whether it is pharmacists or scientists, and even good competence in terms of manufacturing. And with this PLI scheme, we are going to become more and more backward integrated. And that again would lead to India, coming out as one of the key players, which it already is. An interesting aspect which we have to also understand is that, with this Russia-Ukraine issue, gas prices have shot up in Europe by almost 15x. So any company which is power intensive has become non-competitive as far as Europe is concerned. And a lot of shift of manufacturing is going to happen over the next 10, 15, 20 years. And now with a pragmatic policy, government, tax benefits, we do believe that manufacturing in India is going to be a big theme, but we have to keep an eye on. And the last bit is, capex has finally come back. Government is pushing a lot. I mentioned to you about roads and airports. We can see that happening. Metro is being constructed or being implemented in almost 50 cities in India. Again, huge capex. And private sector capex is also now coming back. So last 5 years, there were hardly any capex. Now, power companies are expanding capacity, steel, metal, cement. Across the board, companies are expanding capacity. So capital good companies also should do pretty well.
Great. Hello. Yeah. So one more question from my side, and then I'll start taking questions from the chat box.
Yeah, you take question from Q&A session if you want.
I'm not able to hear you. Sorry. So what we have seen in probably last few quarters, that most of the profits, incremental profit, has come from the commodity and the financials. And when you spoke about commodity coming off, and we just saw one of the results coming today at a very weak numbers. Do you think that Nifty earnings will actually keep growing the way it is growing in the near future, and with the margin shrinking because of various factors, including obviously raw material or dollar rupee going up, which will actually make import?
So I think it's a logical question and a good question, but let me just give you a little bit of a perspective. So if you look at Nifty, 50% of the companies have no impact whether commodities go up or go down, which will include financials, which will include IT, which will include to some extent pharma. Of the balance 50%, 25% benefit if commodities go up, and 25% benefit if commodities go down. So yes, you are right, metals did very well last year. Now the consumer of metals like auto and all will do very well this year. So I think overall, as far as Nifty is concerned, there has been no upgrade or downgrade despite commodities having corrected, and I think that is the strength as far as India is concerned. India is not like Brazil, which is 67-70% commodity, or Russia, which is 80% oil and gas. We are very diversified. The weightage of metals in the Nifty is like what, 6-7%, so it's not going to have any impact.
Taking questions from the chat, what are the opportunities in sugar companies or sugar sector, specifically considering the ethanol policy?
Sir, I will answer this question, but see, if we start discussing every sector, there will be no sector which will be left. But I'll give you a little bit of perspective. So sugar used to be one of the worst sectors because, you have to understand one thing. On one hand, you have the farmers and on the other hand, you have the consumers. And the companies were sort of in between. The government cannot disappoint the farmers. So the sugar cane prices kept on going up. And the sugar was such a sensitive subject, the government could not antagonize the consumers. So sugar prices were controlled. And therefore, the sugar companies never made money. In fact, most of the sugar companies were always perennially sick. I think what has changed is a couple of things. One is the government has come out with a minimum selling price. So they don't allow sugar prices to fall below a particular level because the government has realized that if sugar companies become sick, the worst hit is going to be the farmers because they will not be paid the dues for sugarcane. And the second is this ethanol policy. India realizes that they're completely dependent on external fuel, and therefore they are encouraging 20% blending of ethanol in every fuel which is being used. And ethanol is now being produced from obviously sugarcane, as well as waste crops. So if you have broken rice and so on and so forth, and I think that has made profitability of sugar companies very sustainable, and therefore you have seen there has been decent re-rating also in that sector. Going forward, our view is that irrespective of the oil prices going up and down, I think this ethanol policy is a long-lasting and continuing policy. And that should ensure that sugar companies keep on making reasonable and sustainable profit.
Right. One question about probably a firm. What is the fundamental investment philosophy of Abacus? And what probably is the 3 or 4 KPIs used by Abacus to analyze a company?
So see, as I mentioned earlier, at Abacus, we believe in investing in profitable companies, companies which grow profit, and where what we pay is justified by way of future profitability. And to that extent, therefore, what we are doing is as follows. We invest in companies where the return on equity is at least 14-15%, where at least the profit growth is 14-15%. And ideally, so if you grow profits at 14%, you do profits in 5 years. And where ideally, your P ratios are not very high. I think what we have also done is created a framework, which we call the MEETS framework. It is very simple, MEETS. M stands for management. So, we all know that good management is very important. But for us, good management doesn't mean that the management has to be Harvard educated or Stanford educated only. For us, good management means balance sheet. So whether the return on equity is there or not, whether the cash flow is there or not, whether the company is showing profits or making profits. There are companies which show profits and there are companies which make profit. We want to invest in companies which make profit. Then the E comes. E is the earnings part. I mentioned to you, we invest in companies where earnings can double in 4 to 5 years. The second E is very important, events, trends, and disruptions. We are living in a disruptive world. You can't buy anything for 30, 40 years and forget about it. And therefore, you have to be very aware of what can hit a particular company or a sector going forward. For example, newspapers, great businesses and great moat. If you are hooked to reading a particular newspaper, you will read that newspaper for life. But advertisement is now shifted. Almost 35, 40, 50% of the advertisement is shifted to other medium. Even reading newspapers for the young guys is not a compulsion. They consume news on digital media, and therefore, they're getting disrupted. Or even EVs, Tesla has a market cap which is more than the market cap of all the other auto companies put together. So disruption is going to cause a lot of issues in terms of your investment decisions, and one has to be aware of it. Then comes T, which is timing. We can't time the market, but our view is that the best company is not necessarily the best stock. And I always say this, I've written notes also that there is a bubble in quality. In India, there are quality companies which are trading at 70, 80 P multiple. We are not in that camp that we can buy anything at any price, because ultimately when you are investing in a company, you're becoming a partner in the company, and you would not like to become a partner in the company which is growing at 10% and which is trading at 80, 90 P multiple. And the last bit is a structural bit. India is a great country. India is a fast growing economy. There will be some new sectors, some new companies which come up, which have the potential of growing 30, 40% or faster over the next 5, 10 years. I think those companies will have to be valued very differently. So this means framework is like the Gita or the Bible for us. And obviously we have a full process, which we call the 5D process, which we follow. Internally, we have a very strong team. We started with 14, 15 member team, which 8 were on the investment side. We are now 70 members strong, of which 15 are on the investment side. And I think we believe that, the performance is the heart and soul of the asset management company, and assets or inflows are an outcome rather than a target.
Understood. One more, probably more of a tactical kind of question. If somebody has to put an extra money right now, which market capitalization you should look at, like small cap, mid cap, or large cap at this point in time?
See, that depends on the investor. One has to be very clear. When you invest in cap, your wallet is lower, but your return over a period of time will be lower. When you invest in a mid and small cap, the volatility will be very high because these are smaller companies. They will get impacted fundamentally also more. Like in COVID, the larger companies would survive, the smaller companies would have a bigger impact. But when things become normal, they also tend to grow faster. So depending on your risk appetite, I think the investor has to take a call. Investors who have a longer term vision of say maybe 5, 7, 10 years and who can digest the near term volatility, I would suggest more of mid and small cap. But investors who can't digest and or roz dekhenge ki mera kya hua, they should stick to large caps.
One question from the chat, and probably we'll end after 2 more questions from there. It's a very common question, but I think you touched upon also, but probably you want to take it up again. What will be the impact of quantitative easing or tightening, of USA, specifically with relation to Indian economy?
So tightening already started. We have had 2 increases in US of 75 basis points each. And we saw, dollar strengthening, and we saw yields increasing, and we saw all other asset classes having an impact. So there is a direct correlation. If tightening happens, obviously there is going to be an impact on global equity markets. And we saw that in India also. However, as I said earlier, the markets have already started discounting a very, very sharp tightening. And at the margin, it is possible that tightening will be lower than what the market has already discounted. And therefore, the markets have started to react positively. But this is something which an investor has to track. If oil prices again become $130, $140, I'm very sure that there will be further tightening. And to that extent, the markets will be volatile.
Understood. One question, if you allow, it is beyond equity. You have any view on cryptos?
I don't understand crypto, and therefore I don't invest. See, for any investment in any asset class, you have to see the underlying. So when you invest in fixed deposit, you see the bank. When you invest in corporate bonds, you see the company. When you invest in equity, you analyze the company's balance sheet, you analyze the company's factory, whether it exists or not, you analyze the company's profit. When you invest in gold, you have gold as an underlying. When you invest in property, you see the apartment, you see the office, and then you invest. आप थोड़ी paper पे invest कर देते हो. In crypto, you can see nothing. So it is hope investing, at least as per me, but I might be wrong. I don't understand it. I don't invest.
One more point which you touched upon during your presentation and your answering some questions is that there are a lot of tech companies which are obviously not making profit but trying to create a habit. And since these times when these companies are at a very deep discount, do you think it is a good time to pick these up? I'm talking of more about unprofitable companies who are trying to make
Discount to what?
okay, discount is the wrong word to use at a discount to the peak price.
Was the whole perspective of investing based on how much they have fallen from the top is the worst thing to do. 10 रुपए का सामान 100 रुपए में लिस्ट हुआ, अभी वो 100-60 हो गया, तो you are investing just because that 100 has become 60. We don't prescribe to that. All of these companies are great companies. They have created lakhs and lakhs of employment for Indians. They have helped us a lot, and salute to all the entrepreneurs. But as investors, we look at whether we are going to make money out of investing in that company, and that investment decision is not based on how much they have fallen or how much they have risen. That investment decision is based on what you are paying today and what you are going to get out of future profitability. Most of the companies, at least we cannot see as of today, any profits being made. If we see that, we will change our view, but right now we don't see that. But don't invest just because something has fallen 40-50%. That is not the
question
way
is
of,
more about whether
it is least expected from educated professionals like chartered accountants.
No, the question was different. So, do you see price value at this price? The correct question would have been that.
So that value should not be based on how much they have fallen.
Yeah.
That value is based on what you see. As I said, if you are a 50-year investor and you see that these companies will eventually make profit, maybe you can invest. In most of the companies, we are not seeing that. So till we see that, we will not be investors.
Great. I think we have touched upon most of the questions. Otherwise, there are more sectoral questions. So I can call upon.
Sir, whether we have taken question of Aditya, he is asking that I heard you saying Europe is exploring alternatives like nuclear energy, hydrogen, etc. Where do you see this going 5 years from today?
Okay, so see, I cannot comment on what Europe is going to do. We can only comment on their actions. So, I'll give you a little bit of a brief. There was a big accident 10-15 years back in Japan. There was a tsunami, and one of their nuclear plants, all their plants needs continuous energy, backup energy. Otherwise, the fuel, which is uranium, can leak. And you know what will happen if the fuel leaks? It will destroy the entire region. For those who want to learn more, there is a good movie called Chernobyl, Chernobyl, which was a region in the erstwhile USSR. It's there, I think, on Amazon or Netflix. You can have a look at it. But when that near accident happened, fortunately, the accident was prevented, but it led to fear among people, and therefore most of the European countries who were having a lot of nuclear power plants, they mothballed it. Mothballed means they just shut producing nuclear energy from it. And because oil was cheap and it was available, you could do that. But now when they are seeing that they are dependent completely on Russia, and particularly Germany, whose life has become miserable, because Germany is one of the largest manufacturing countries in the world, and they cannot get enough oil and gas. And even if they get, it is so expensive that they're becoming non-competitive. I think they have all started exploring whether they can restart the nuclear plants. Obviously, the people in those countries might have a different view, but at least they're trying to do it. In fact, 15 days back, the European region declared nuclear energy as renewable energy. So they're making the grounds to do that. We don't know what is going to happen. On the hydrogen front, a lot of companies are investing billions and billions of dollars. In India, we have seen both Adani and Ambani's announce almost $20-30 billion plan of investing to make hydrogen viable. Let's see. I think if so many countries and companies are working on it, something will come out. But that is the best thing which can happen to India, because if the reliance on oil for India reduces, you imagine we will have no trade deficit, we will be a strong economy, because that out of the $20-25 billion a month of trade deficit, oil and gold contribute almost all of it. So hopefully the lure for gold will reduce and oil dependent will reduce if some revolutionary innovation in terms of hydrogen or other fossil fuel, non-fossil fuel happens. But I am very optimistic. I do believe that in the next 4-5 years, there will definitely be path-breaking innovations in that area.
So we are more or less done with the questions. What do you think?
Thanks a lot. I think one last thing which I would like to leave all of you with is be positive. In the near term, there will always be some concerns. I always say that there are 180 countries and 200 factors in each country. If we start to tick mark every factor, there are 40,000 factors to be tick marked. And if all 40,000 factors have to be tick marked before you start to invest, you will invest when the Sensex is at 5 lakh, not when it is at 50,000.
Right, over to you.
Hello. Yeah, there is one more last question is there. My question is related to HDFC Group. For the past few years, it's been underperforming because of RBI.
I can't comment on individual groups and companies. I'm very sorry.
Good. Okay. So I think most of the question we had answered. So if there is any more question, we can wait for 1 minute. Otherwise, we can move forward to give a formally vote of thanks for Sunil. Sunil, thank you very much for accepting my invite. I am very much glad that you had accepted my invite and you had deliberated so well. Now I invite CA Vikas Jain to propose a hearty vote of thanks to CA Sunil Singhania ji. Please, Vikas ji.
Right. Good evening, Sunil ji. It was indeed a pleasure listening to you after quite some time. And you clearly dissected the Indian economy and how it is progressing, giving us a fillip that equity is the best asset class to be in, be it in the medium term or the long term. The questions you have, answered has been with aplomb. So we are very, very grateful, sir. On behalf of Western India Regional Council of the ICAI, I heartily place on record our sincere vote of thanks for sparing the time and talking to us and interacting with us. And in the same vein, let me also thank Ms. Pinky Kedia, who has been kind enough to ask me to be, to do this honored task of thanking an icon such as Sunil sir. Pankaj, you have been brilliant in coordinating the whole show. The audience deserves a round of applause for making the interaction so participative. And of course, the technical team of WIRC, who has, taken all the pains to ensure a grand success of this event. So look forward to more of such shows and in person too when we are in Bombay, sitting across the table. Thank you very much, sir.
Thank you. Have a great day and a great event. Be positive. Thank you.
Thank you very much. Thank you, everyone.
Thank you, Sunil ji. Thank you. Thank you, Pankaj ji. Okay.